Hello, welcome to this lecture. We're still continuing on Unit 2, Accounting for Financial Instrument. And in this session 2, we'll be looking at IAS 32, Financial Instrument Presentation. IAS 32, the name of the standard is Financial Instrument Presentation. So that is what we'll be looking at in accounting for financial instrument. At the end of this session, these are the objectives we have to achieve. A. To define financial instrument and the various categories of financial asset, financial liability, and equity. B. To discuss the distinguishing features of financial liability and equity. Then C. To explain how compound instruments are accounted for. D. To account for treasury shares. And E. To explain how interest, dividends, gains, and losses related to financial instruments are recognized and the offsetting rules. So basically, these are the 5 main objectives we'll be looking at in this session, and it must be achieved. What is the main objective of IAS 32? The objective of IAS 32 is to establish principles for presenting financial instruments as liabilities or equity. Now, its presentation requirements are consistent with and complement those in IFRS 9, which addresses recognition and measurement criteria, and IFRS 7, which covers the disclosure requirements for financial instruments. So that is the main objective of IAS 32, to establish principles for presenting financial instruments either as an asset, liabilities, or equity. Then it tells us the presentation requirement, and this presentation requirement is consistent and complements those other standards that are in line with financial instruments, which are IFRS 9 and IFRS 7. Now, when we say financial instrument, what does it mean? Financial instrument. A financial instrument is any contract that gives rise to a financial asset of one entity and a financial liability of or an equity instrument of another entity. So it's a contract. Must be underlined. It is a contract. And if it is a contract, this contract have to give rise to a financial asset of one entity and a financial liability or equity instrument of another entity. So we have this contract. There are two parties to the contract. So to one party, it is a financial asset, but to the other party, it is either a financial liability or an equity instrument. So we are looking at the debit side and then the credit side. To you, that it is a financial asset to you is an asset, so you control the asset. Having a debit balance and to the other party, which the contract will either be a financial liability or an equity instrument. They are all credit items. So at the end of the day, you have to balance. The debit side must correspond with the credit side. So when we say financial instrument, these are the elements in the definition we are looking out for. First, it is a contract, and this contract have to give rise to a financial asset of one entity and a financial liability or an equity instrument of another entity. That is what we mean by financial instrument. Then in the definition, we made mention that this contract give rise to a financial asset. So we want to now define, explain what we mean by financial asset. So when we talk of financial asset includes cash, equity instruments of other entities held by the entity, equity instrument of other entities held by the entity. So what we mean here is that you have an equity instrument of another company which is in your possession now. Then we have a contractual right to receive cash or another financial asset from another entity, which we call receivable. A contractual right. So you have the right to receive cash or another financial asset from another entity. So it's giving you the contract that is giving you this contractual right to be able to receive that. And also, as part of the definition of financial asset, we say it's a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable. Potentially favorable, underline. Because it's an asset to you, you determines how you use it, how you control it. So you only look for things that are favorable for you. And based on that, you go in for it. So it's a contractual right to exchange financial assets or financial liabilities with another entity under conditions that are potentially favorable to the entity. And this definition comprises of the financial derivative with a positive fair value, because you are certain that whatever you are going to invest in, whatever exchange you are going to make at the end of the day, will be that which is potentially favorable. So these are the elements of financial asset. When you are defining a financial asset, these are the things that it includes. These are the things that it entails. Now we look out for the second element in the definition. It is like this: the contract will either give rise to financial asset of one entity and a financial liability or equity. So we want to look at the financial liability, what it means to say there is a financial liability. Now, financial liability is any liability that is a contractual obligation. So the first aspect is that it is a contractual obligation. A contractual obligation. Now, this contractual obligation is to deliver cash or another financial asset to another entity. So you have the contractual obligation to deliver cash or another financial asset to another entity, or you have a contractual obligation to exchange financial assets or financial liabilities with another entity under conditions that are potentially unfavorable to the entity. So we look at potentially favorable under asset, but when it comes to financial liability, the exchange that you are doing, the contractual obligation will be potentially unfavorable to you. Let's take an example like you need funds. So you went to the bank to take a loan, and the bank will give you conditions that are attached to the loan. It is not all of them that are favorable for you. But the bank who is giving you the loan is an asset, so they will look for their interest. So things that will be favorable to them is what they will give. But you at the receiving end, which will become a liability for you, you have no option than to accept it because you are the one in need of it. So there are some conditions that will be potentially unfavorable to you, the entity. Now, the second aspect is that financial liability is also a contract that will or may be settled in the entity's own equity instrument. So it's a contract that will or may be settled in the entity's own equity instrument and is a non-derivative for which the entity is or may be obliged to deliver a variable number of the entity's own equity instrument. So with this one, you are obliged to deliver a variable number of what? Your own equity instrument in fulfillment of that contract. Then the second one is that it's a derivative that will or may be settled other than by the exchange of a fixed amount of cash or another financial asset for a fixed number of the entity's own equity shares. So what we are basically saying here is that a financial liability is a contract that will or may be settled in the entity's own equity instrument. So you are going to use your own equity shares to settle this liability at the end of the day. And in so doing, the first aspect is that it's going to be a non-derivative financial instrument. When we say derivative is where there is a linkage between what or the instrument derive its value from a certain underlying instrument. So in so doing, we are obliged to deliver a variable number of your own equity instrument in settlement for that liability. And then the other option is that you are going to use a derivative that will or may be settled either by the exchange of what? A fixed amount of cash. So you are going to pay with cash now, but this cash or a financial asset is fixed as a certain number of your equity shares. So what is the value of the equity shares? They peg it against a certain amount, and that is what you are going to use to settle it. And that is what we mean by a financial liability. It's either a contractual obligation or that must be settled in the future under unfavorable terms, or you come to a contract that may be settled in the entity's own equity instrument. Then we take the third element or the third aspect. If it is not a liability to the other party, then it has to be equity instrument. And what do we mean by equity instrument? Now, equity instrument is basically a contract that demonstrates a residual interest in the asset of an entity after taking or deducting all of its liabilities. So it's a contract that demonstrates a residual interest in the asset of an entity after deducting all of its liabilities. So you have an asset that you use to run the business. After taking out all the liabilities from the asset, what is left is the residual interest, which we call the equity instrument, and we popularly call it capital. So we have the accounting equation, which we say that your asset is equal to capital plus liability. So asset is equal to capital plus liability. That is how we usually write the equation. And to get capital, we say capital is equal to, your capital is equal to asset minus liability. And this is what we are referring to as the residual interest. The residual interest at the end of the day. So this residual interest is the equity we are referring to. So your capital is equal to asset minus liability. Now let's talk about putable instrument. Putable instrument. A putable instrument is a financial instrument that gives the holder the right to put the instrument back to the issuer for cash or another financial asset, or is automatically put back to the issuer on the occurrence of an uncertain future event, on the death or retirement of the instrument holder. So you have an instrument, you have made an investment of which you are the holder of the investment. And we are saying that when you talk about putable instrument, you the holder of that instrument, you have the right to return, to put, or to send back to the issuer, the person who issued the instrument before you bought and you became a holder. You have the right to send it back for cash or another financial asset, or you automatically put it back based on the occurrence of what? Uncertain future event, or based on the death or retirement of the instrument holder. Then you send it back and your cash will be given back to you. So that is what we mean by the putable instrument. Now let's look at the classification as liability or equity. We said that this contract, which is a financial instrument, to one party it is an asset, but the other party, it has two options. It's either it is a liability or equity. So we want to look at the classification as a liability or equity. Now, the characteristic of the financial instrument should be considered to ensure that it is appropriately classified. So in doing this classification, you need to look at the characteristic of this financial instrument as to whether it qualifies to be a financial liability or a financial or equity. And it is also important that the substance of a financial instrument is considered rather than its legal form. So we are looking at the substance of a financial instrument is considered rather than its legal form. So what we mean here is that, for example, you might have a car. Legally, you own the car, but you gave the car out to somebody to be using, or to a cousin to be using, and he enjoyed the benefit associated with that car. So the substance of form is with that individual who is, or your cousin who is using the car, but legally you owns the car, but you are not the one using it. So when you are accounting for that, the benefit and co goes to the person using the car. So we are looking at the substance of the financial instrument rather than its legal form. Now, some forms of financial instrument are legally classified as equity. So legally, when you look at their nature, it is equity, but they have the characteristics of financial liabilities and should therefore be classified as such. So if the characteristic is a financial liability, though its legal form is equity, you have to classify it as a liability. So this is the classification criteria as to whether you are classifying as equity or liability. Now let's look at compound financial instrument. Compound financial instrument. A compound financial instrument is one that contains both a liability component and an equity component. There is a liability component and an equity component. A compound instrument should be splitted into its component part at the date that it is issued. So you have to split it into equity and liability. An example of a compound instrument is a convertible bond, where you have the option to convert it to either equity at the date of maturity or to take cash. So it has two main elements here: a liability component and then the equity component. At the date it was issued, do the splitting, then you determine the liability and then the equity at the date of inception. Now let's talk about dividend, interest, gains and losses associated with financial instrument. Where we have interest, dividend, losses or gains which arise in relation to a financial instrument that is classified as a liability, this interest, dividend, loss or gain should be recognized in profit or loss for the period. So if it is a financial liability and there is an interest, dividend, losses and co associated with this financial liability, send it to profit or loss account. Now, dividend payable in respect of a financial instrument that is classified as a financial liability are classified as an expense. So if you are paying dividend based on financial liability, you classify this dividend that is paid as an expense, and as such you send it to profit or loss account. Now I have distributions such as dividend paid to holders of a financial instrument classified as equity should be charged directly against equity. So we are talking about equity now. So if you paid any amount to the holders of this equity instrument in the form of dividend and co, charge it against the equity. So you go to statements of changes in equity and take that amount out. But if it is a liability, you bring it to profit or loss account as an expense. Let's look at treasury shares as one of our objectives. Treasury shares. Treasury shares are shares which are reacquired by an issuing entity, thereby reducing outstanding shares. So treasury shares. They are shares that are reacquired. So an entity issues shares. At the end of the day, it bought its shares back again. So reacquiring a share that you have issued. It is the issuing entity who is acquiring back the shares they have issued, and in so doing, they are going to reduce the number of shares in circulation. Now, this procedure corresponds with the view that a reacquisition of own equity instrument has the same effect as a reduction in capital. So if you reacquire your shares, it basically means that you have reduced the capital in circulation, or the capital you are using to work with. So a purchase, sale, issue, or cancellation of equities, an entity's own equity instrument, neither affect profit or loss nor other comprehensive income. What the statement means is that when you reacquire your shares, it has nothing to do with profit or loss account, because it's a movement in what? Equity. It's going to be between your cash and the equity. So if you are reacquiring the shares, the double entry will be, in what form are you paying? Is it through cash or bank? So you credit the cash or bank, and then the corresponding debit entry comes as a reduction in the equity instrument. So there is nothing going to profit or loss or other comprehensive income. That is what the statement means. Now let's look at the last thing under this session, which is offsetting. Offsetting. Now, before an entity will be able to offset a financial asset against a financial liability, these two conditions must be met. The two conditions must be met. One, the entity currently has a legally enforceable right to set off the recognized amount. So you have the legal enforcement. You have that right to offset a liability against an asset and present the net amount. And then the second is that the entity intends. So the legal enforcement is not there, but the entity now intends either to settle on a net basis, that is taking a liability from the asset, whatever is left, then you settle, or to realize the asset and settle the liability simultaneously. So it's two. Either you go with a net basis or you recognize the transaction separately. So these two conditions must be met before an entity can offset its assets against the liabilities and present it in the statement of financial position. So throughout this session, we've been able to look at IAS 32, its definition and component, and in the subsequent sessions, we'll still look at the other aspect in accounting for financial instrument. Try as much as possible to read the model given, solve more questions, ask more questions as well if you need clarification. We'll meet for the next lecture. Thank you.